Well, it's time to do business again. Welcome to Business Incorporated. We have 25 minutes this time around, and here's what we've prepared for you. We're looking at the Tier 1 banks. There's a report from ProShare gauging their health status. In South Africa, rates have been held, just like Nigeria. And Zimbabwe is targeting $2.5 billion import bill. Welcome to the program. Let's see what's happening in the oil space since we left it off earlier today. We see that prices retreated again compared to what we have, but that's still for that hefty gains for this week. Of course, concerns about disrupted energy flows in the Red Sea and fears of further escalation in the US-Israeli war with Iran. And so we see that Brent has lost 3% now. It's dropped from $98, which we saw in the morning. It's now at $97.62. WTI almost 3%, 2.96% at $89.49 a barrel. We know that US President Donald Trump has promised major military punishment for Iran and its Houthi allies after the strikes in the Red Sea. Closely related to that, we see natural gas also dropping following all of this. 1.03% in the red, and the price is $2.88. And the metals, we see gold ticked higher on Friday, reversing earlier losses. Oil after following oil below $100. And so we see that spot gold 0.30% in the green, $4,062.40 per ounce. Spot silver 1.18% in the green, $58.75. Platinum is 0.28% green, $1,613.30 per ounce. And palladium is on the flip side, 0.5% down. It's $1,256. Copper follows the other, 0.24% in the green at $6.35. Investors are eyeing U.S. Federal Reserve's policy meeting next week, when it's largely expected to keep rates unchanged. That's what everybody's doing, staying safe for now in the midst of all of the uncertainties. So that's what the U.S. Reserve is also expected to do next week. And of course, investors are also holding their breath for that. Now, Zimbabwe is moving to cut its annual import bill to $2.5 billion through an ambitious import substitution strategy that's aimed at boosting domestic production and reducing reliance on foreign goods. The government says that the initiative will focus on expanding local manufacturing, strengthening agricultural value chains, and increasing the production of goods that can be made within the country. The proposed Local Content Act, expected to take effect in 2027, will restrict imports of products that can be produced locally, including selected consumer goods, pharmaceuticals, industrial products. Authorities say that the policy is designed to conserve foreign currency, create jobs, and improve the competitiveness of Zimbabwean industries. Tanzania is set to list its first offshore Tanzanian shilling-denominated bond on the London Stock Exchange, and that will mark a major step in expanding access to international capital markets. The listing is backed by the International Finance Corporation, that's the IFC, and is expected to attract global investors while diversifying funding sources for the country's development projects. Finance Minister Kamis Musa Umar, who is in London for the listing ceremony, says the bond will support financing for key infrastructure projects, including standard gauge railway, ports, roads, and energy. The minister is also using the visit to present Tanzania's Development Vision 2050 and promote investment opportunities in manufacturing, agriculture, mining, tourism, and renewable energy. The government says that the landmark listing is expected to strengthen investor confidence, deepen Tanzania's presence in global financial markets, and mobilize long-term capital to support economic growth. And South Africa, the Reserve Bank there has kept interest rates unchanged, defying expectations of a rate hike. The Monetary Policy Committee voted 4-2 to leave the repo rate at 7%, with 2 members favoring a 25 basis point increase. The decision comes despite renewed inflationary pressures and heightened global uncertainty following the collapse of the ceasefire between the United States and Iran. Our correspondent Innocent Semusa has more on this.
Reserve Bank Governor Lesetja Kganyago says although inflation has picked up and global risks remain elevated, South Africa's broader economic indicators suggest the current interest rate setting is still appropriate.
The committee decided to keep the policy rate unchanged at 7%. 4 members preferred a hold, while 2 favored an increase of 25 basis points.
Economist Makwema Silela says the Reserve Bank's decision to keep interest rates unchanged came as a surprise despite inflation rising to nearly 5%.
Our central bank surprised most analysts as they left interest rates unchanged, given that we've seen yesterday that the consumer inflation jumped to almost 5%. So expectations were that we will get interest rate hikes, but the guys left them unchanged. And their main reasons are they are worried about the economic growth risk.
He says the MPC is balancing inflation risks against weak consumer and business confidence while leaving the door open to either a future rate hike if risks worsen or a rate cut later this year if inflation eases.
If things continue the way they are, as oil prices still at elevated levels, with the renewed conflict, escalating in the Middle East, the guys didn't rule out the possibility of increasing the rates. And in the very same breath, they also didn't rule out the possibility of lowering interest rates still this year.
Meanwhile, the SARB says services inflation remains a key risk to the inflation outlook. Standard Bank Group Head of South Africa Microeconomic Research, Dr. Elna Moomen, weighs in.
The Reserve Bank is particularly concerned about services inflation, which can be quite sticky and which the SARB at this stage sees as problematic. It is therefore not impossible that we could see interest rate hikes later this year, depending on how these inflation risks unfold. For now, however, the Reserve Bank describes interest rates as appropriate, and its model implies that there could be scope for interest rate cuts from later this year.
From Johannesburg, South Africa, Innocent Samosa, Channels Television News.
So everybody is holding rates, at least almost everybody is holding rates now. I'm just waiting to see if things will get better so we can expect a cut, or else there might be a hike, as economists there shared. But let's talk about a Nigerian bank now. ProShare, they have released their Tier 1 bank report. This is the 5th edition, and it's an interesting one, seeing that banks just concluded a recap for in March 31. So we'll look at a bit about the health, and we've seen the bank like First Holdco shining in the last couple of days, about a week. So from one news to the other, from the 5 trillion naira market cap to a new share price to an increase in the stake of Mr. Tedola, and a whole lot more. But what does all of this mean for the banking sector, the health of the banking sector? Let's just look a little bit about some of those new developments from the banking sector in recent times. So we know that the banking sector, they just completed their largest recapitalization exercise, March 31st. We know that 33 banks scaled through with approximately 4.65 trillion naira raised through that recap exercise. We ask the question, can raised capital convert to clean, loss-absorbing balance sheets during earnings and disciplined governance and productive intermediation? And we know that Wema Bank got into the Tier 1 table following that recap. First Holdco, we know, they also hit that 5 trillion naira market cap. Let's explore this now with the Director of Research from ProShare, Mr. Taslim Shitabe. Mr. Shitabe, good afternoon. Welcome to the program.
Good afternoon. It's a pleasure to be on the program. Thank you for having me.
Good to have you. It's been a very busy banking sector. We've had pre, recap, and post. And we've seen some of those movements. For instance, Wema Bank and then First Holdco. But apart from the individual banks, what does this tell us? Or perhaps your reports from ProShare on the Tier 1 banks, what does it tell us about the health status?
Okay, thank you very much, Ini. Number one thing that came out of the report that we had not analyzed in previous reports was that comparing Nigerian banks to African banks, where do we play? The mean price to book value for African banks, the whole cohorts we analyzed, which was about 45, was about 0.99 multiple. That's times. Every Nigerian bank was below that multiple. Every single Nigerian bank was below that multiple. And it's not new, because if you look at last year, we weren't even in the top 20 banks in Africa. Well, don't let me say we weren't in the top 20. We weren't in the top 10. But in terms of the top 20, we're at 15, 16, 17, and then 19.
So even towards the end part
of the thing. Now, recapitalization came in. That has restructured this narrative. We've seen more Nigerian banks get into the top 10, which is brilliant. And of course, much more in the top 20. And that generally is the direction we wanted to see Nigerian banks. But it's not just about size. Our report emphasizes quality, capital, the quality of the capital. And remember, under Soludo, Governor Soludo, currently Governor Soludo was the governor of the central bank then, he's now a governor of a state. We did this same exercise, right? So we moved banks from 2 billion naira to 20 billion naira, 10 times. Exactly what we're doing now. We moved it to 10 times. But what did it translate to? Did we see the economy expand? Do we see the kind of
credit to real economy?
Yeah, to the real economy. We didn't see that. But that was one of the purpose of those reforms then, that recapitalization. So currently, the CBN, in its wisdom, has reviewed the whole system and said, look, it's not just about scale. It's about strength. How strong are these banks? What is the quality of capital that they have? And that's what we did a deep dive into in this recent report. So that's why you see a Wema Bank, who most people would have wondered, how in heaven's name did they get into the top? When we have a further conversation, I'll explain why. But that is precisely...
I think you should go ahead and tell us why.
I should tell you.
And help us to understand this massive movement around First Holdco too.
Okay, let me start with Wema. Because we were looking at efficiency in the banking sector, we looked at real return on equity. Wema Bank has the highest real return on equity, 23.01%. So even GT that came to the top had a real return on equity of 8.75%. So the bank might be relatively smaller, 260 billion actually currently, if you look at their total capital, but they are very efficient. And they've made sure that their cost to income ratios are low. Same thing for GT. Now let's come to First Holdco. Obviously, one of the big boys in the system, right? Over 100 years old. So we expected that this...
Are they still the biggest market cap in figures?
No. There are banks that are higher than them. And we have the Zenith, we have the Access banks, and then they follow after ETI. But the good thing here is the quality of First Holdco's loan assets. They've cleaned up their books, right? In the past, yeah, they were big, but they had problems with their loans and advances. And so loan loss provisions were very high. Currently, we've seen a reduction in loan loss provisions. Most importantly for us, cost to income ratios are much lower. First Bank, we used to have cost to income ratios above 60%. Currently, they're in their 40s. So it's not a surprise that one of the key stakeholders says, look, I think there's something here, and he decided to increase his stakes. It's not a surprise that they're at 105. As the last time I checked, 105. From 95, they went 10% in a day, went up to 105. It's not surprising.
They hit 110 at some point.
Yes, at some point they did 110. Yeah. So that's understandable, trying to catch up with GT. I didn't say so. But it's important to know that First Bank is currently re-engineering itself, repositioning itself to where the new major stakeholder wants it to go. One of the largest banks in Africa, not only in Nigeria, but in Africa. And I think it's going along that trajectory.
But, at the end of the day, if they cannot make impact on the real sector, we know that there's high interest rates. We know that CRR is at 45%. But if with all of these good qualities, we don't feel the impact in the real sector, then it's almost for nothing.
Okay, let's put it this way. There are certain things that are beyond the bank's capacity, and they revolve more around regulatory concerns. The central bank, rightly, has decided that it was more concerned about inflation. Inflation is 15.91%, not yet at the lower rates, the single-digit rates that the CBN expects. And since it's no longer at that rate, we expect that the policy rate will still remain high at 26.5%. And as long as that policy rate remains that high, and then you have a high cash reserve ratio, not much will happen. The cash reserve ratio is at 45%. At ProShare, one of the things we have argued is that, you know what, keep your rate where it is, but reduce your cash reserve ratio. Bring that cash reserve, creating more liquidity in the banking system, therefore allowing more money to go to the real sector that you're talking about at competitive rates. Because at 30%, 32%, it's really difficult to make any meaningful margin on those kind of rates. So, yeah, that's our general.
So, apart from that recommendation on the Sierra, what other recommendation comes from your report?
Well, less of recommendations and observations, really. Banks will do what banks do best, make money. But for us, like you've rightly pointed out, real sector, we've recommended that we have to find a way of following resources to the real sector. We may need to be more creative in the kind of loans we give to the sector. So we segment the sectors, target them in respect of their growth potential, and funnel them there. We call it the plumbing. We need to reorganize the plumbing of the Nigerian banking system. And we think the regulators could help a lot in doing that.
All right, I hope you have words with them. I know that ProShare is very influential in the financial sector. So
we think so.
We hope you use your influence in this area. Thank you so much, Director of Research at ProShare, Mr. Teslim Shitabe. Thank you for your time.
It's been a pleasure being here.
All right, now, so talking about the market, let's see how we're looking at intraday. We can tell you that intraday, that the NGX is positive at this time. So it's a good one. We're staying on where we closed, or at least building on that. So we also see for the Middle East, some of them, two of them that trade, they're actually negative at intraday. And then Egypt is closed, and then NSE, that's for Nairobi, that's from yesterday. In the United States, we saw futures were broadly higher in early trade, stabilizing after a tough session, which a sharp spike in oil prices affecting everybody, I must say, the issue around the oil prices. So the Dow has recovered, S&P is positive as well as NASDAQ. In Asia, markets closed in the red, feeling the pinch of that. South Korean equities leading the losses. Also, the Kospi plunged 5.7% to 6,690, and Nasdaq fell 5.3%. Right there, it's a red market for them, and they are closed for the weekend until Monday. So let's see what's happening in Europe. We have Lars joining us now to give us updates on that. Hi, Lars. Good afternoon. What's the color of your market?
Yeah, good afternoon, Ini. It's good to be with you. Well, I can tell you markets here in Europe are in the green, actually pointing to the upside on a Friday. However, it is kind of hard to make a case for it. Of course, the oil price is down a bit today, and that's what a lot of people here are definitely seeing as a positive. But, you know, if we're honest, the oil price is also up by around 10% over last week. So that's obviously not good. And then in general, looking at Europe, an analysis just came out for seeing inflation a bit higher than the ECB had been hoping for. And part of that is, of course, due to the oil and other energy prices. According to the report for this year, we should be looking at 2.7% inflation, then 2.2% for next year, with Eurozone inflation not dropping to the ECB's goal of 2% before 2028. But anyway, as I said, the market is up a bit on this last trading day of the week.
Yeah, I should say congratulations. That's not a common thing to see, you know, amidst the increased tension from the Middle East. And then we hear that perhaps the government is getting some reactions from the reforms.
Yes, indeed. Some of Germany's top executives here, such as Roland Busch of Siemens, industrial conglomerate, or the boss of the Deutsche Bank, Christian Sewing, they seem to be quite happy with the initial efforts the Merz administration here is undertaking to strengthen the economy after 3 years between recession and stagnation now. First and foremost, the managers said at a meeting early this week that they see their Made for Germany initiative really as a success. Now, this initiative was started about a year ago, with German CEOs pledging investments totaling more than 600 billion euros here in Germany. Meanwhile, additional firms have joined, and we're up to investment pledges exceeding 800 billion euros.
So what do we know about this investment, Lars?
Well, admittedly, in many cases, they did involve some projects that were already in the planning stages. So a few of those billions of euros that they promised, they would have probably come anyway, but there are also a lot of new projects announced with the same caveat. However, to quote the Siemens boss, he says, we see these investments coming, but not unconditionally. In fact, the managers are saying that they're quite relieved, like I said, over the government's recent reforms, including to income taxes, as well as some significant easing of labor laws. But they are saying that further reforms are desperately needed to make investing in Germany more attractive and also more competitive on a global scale.
And did they note what these other reforms should look like?
Yes, it's mostly reforms to the labor market. For now, for example, the government went back on requiring workers to provide a medical certificate stating starting from the first day of an illness, something that unions and also doctors are very much against, but that CEOs are saying will cut down on cases of people just staying home over a light case of the sniffles or so. And generally, however, the companies want the government to do its part to get more people into full-time instead of part-time work. They also demand lower payroll taxes and lower social security contributions. Those are the two positions that are basically the number one factor for high energy costs here, high labor costs, in Germany. While the CEOs in this week's meeting applaud the government for showing a willingness really to do something here, finally, they're also saying things have to progress fast to prevent even more investment to flow into other countries instead of remaining here in Germany to strengthen the economy here.
Yeah, well, a lot of demands there, but of course, it's expected. Businesses or businessmen are there to make profits. So, but thank you so much, Lars, for bringing us up to date on that. And do have a great weekend, Lars.
And you too. Thank you, Ini.
So let's go to the crypto space. I wonder if we can see the price of Bitcoin. We did see a recovery earlier this week. I wonder if that is being sustained. But let's see what's going on. We see Mount Carmel has formally banned cryptocurrency mining operations and data centers. And this follows a unanimous vote by the town's board of mayor and aldermen. This decision positions Mount Carmel among a growing number of U.S. communities that are opposing the expansion of energy-intensive digital infrastructure. That's one down for the digital space right there. And then also we see that the Clarity Act has reached the U.S. Senate floor, still in the United States. Its path to passage remains uncertain after a revised draft excluded an ethics provision sought by Democratic lawmakers. So we see Clarity Act odds slip to less than a half of a full percent. And of course, that's another 2 strikes down for the crypto people. EU bars, that's the European Union, they've prohibited Belarusian nationals and entities from owning or controlling crypto firms regulated under the markets in crypto assets. I should have asked last that, yeah? But the restriction forms part of the EU's latest sanctions package against Belarus and is aimed at tightening oversight of the digital asset sector. And the measure is expected to limit Belarusians' participation in the bloc's regulated crypto market while reinforcing compliance with the EU's broader financial sanctions. And we end in Philippines, where the PBI test on stablecoin rail remittances is in focus and is set to improve overseas remittances, aiming to make cross-border transfers. At least they are winning in this one about the crypto space. Now, the pilot reflects growing interest among traditional banks in using blockchain technology to modernize payment systems and reduce settlement times. If successful, the initiative could enhance remittance services for millions of Filipinos working abroad. So that's a positive one for them. And then we have 2 or 3 negatives. So we have the price now it's also feeling the pinch of what's going on. That's talking about Bitcoin. It's down 0.5% in 24 hours, 64,868. It recovered a bit this week, but can't hold it in the midst of all the uncertainties. Ethereum is looking even worse. 1,876.41, down almost 1.5%. And of course, we have more reds than we have green on this Friday. So that's it for the crypto space, and that's it for Business Incorporated. Thank you so much for being a part of our journey, Business Morning and Business Incorporated. Please remember you can always watch it on our YouTube channel to get all the information that you may have missed. I'll see you tonight, though. Let's see if the NGX will make us happy for the weekend. I'll see you then.